Okay, so here it is, 12 o'clock p.m. Eastern Time. My name is Kristen Kovalish. I'm one of the financial advisors and partners with the Mahoney Group of Raymond James, and I'm joined by Zach Lindsay. He is a defined contribution specialist with MFS, one of Raymond James's partners. And today we are here to tell you all you ever wanted to know about Social Security. Well, actually, maybe that's an overstatement because, as I'm sure Zach would agree, there's many different intricacies with this topic, but I just kind of want to set the stage to share with you how this program fits into our team's offering as your organization's retirement plan's financial advisor. So the Mahoney Group is a team of 14 professionals, and we have a singular purpose. Our purpose is to help people make progress on their personal financial journey. And that means a lot of things to a lot of people. What it means to the Mahoney Group is that we work with employers on structuring retirement benefits programs that are accessible, understandable, and competitive. And we also work with those employers to educate employees, like you all joining the call, on important topics. And I've been doing this for over 20 years. When I first started, we would talk all there was to know about enrolling in a 401k or a 403b, and the focus had been singularly retirement. What we've come to appreciate and what honestly the market is demanding is financial support and guidance that goes beyond just retirement, because we recognize that we're all unique investors and individuals on unique journeys. In fact, as a team, while about 5 of us work solely on the institutional side of our business, working with employers and employees, we do have colleagues who also work with individuals. And one of the things that is common to both sides is we are seeking to get investors to and through retirement. And at each life stage, that could mean something different. What I love about today's topic, Social Security, is that it is relevant regardless of your income, right? Whether you are someone who is going to have ample income and perhaps estate planning and legacy is a goal, or maybe you're concerned about running out of money during your retirement years, understanding when and how to claim Social Security, and then understanding how that strategy informs other financial decisions is so very important. We are committed to help your employers with their fiduciary responsibilities where they're acting in your own best interest, but then also helping you all make meaningful progress on your financial goals. So as part of that, in addition to plan education, we offer these quarterly programs. I say quarterly, but in the third quarter, we're breaking our rule because we've decided that Social Security and Medicare is just too big of a topic to fit into 1 hour. So as you've seen in the invitation, today's topic is Social Security. On August 21st, we're going to have sort of the sister conversation where we're going to talk about Medicare planning and decisions and how that fits into your financial plan. But be on the lookout. We do have recordings of our first 2 programs during the year, and there will be one on behavioral finance during the 4th quarter. So that's our 2025 employee education calendar. And I'd say most importantly, and then I'll turn it over to Zach, is for you to understand where to go for help. And what I mean by that is you have access to our team for individual questions. Now, we cannot affect change in your retirement plan accounts. I can't change your deferral rates or change your investments. But if you have a question, either specific to your plan or another general financial question, please remember that myself and my team are resources to you. I've included 4 of our contact information for my peers, emails and phone numbers for any follow-up questions you should have. And just in terms of housekeeping, we are recording this session. It will be made available. I know that it's tough in the middle of a working day to attend a live session. So for your peers and colleagues who are interested in the topic, we will make that recording available. And there's also going to be a handy resource guide as well as copies of the slides. So this is a dense topic. Don't feel like you need to take copious notes, right? Because you're going to have these slides and a resource guide to reference following today's program. So I am so very excited to be introducing Zach Lindsay. he talks about Social Security all day, every day. And that's one of the things that my team and I really pride ourselves on, is that we have a lot of knowledge about a lot of things, but when we have an opportunity to bring you an expert, we're gonna take advantage of that, and we're all gonna learn together. So with that, I'm gonna stop sharing my screen and I'm gonna let Zach take it away.
Awesome. Well, thank you for the kind introduction there. And I'm just going to start sharing my screen. If you don't mind just giving me that virtual thumbs up, Kristen, once my screen is shared. All right, awesome. Yes, you did say it was dense, not as dense as the hair on my head versus the profile picture that you kindly showed. The one thing I know is I need to update that profile picture.
Well, I
Um,
think you're not alone in that regard. And actually, as you're starting to talk, I did have one other housekeeping item.
yeah,
So the prepared remarks, 30-ish minutes, give or take, but we know that there might be questions. So feel free
yeah.
to throw, I'm monitoring the Q&A box through Zoom. So I'll be happy to ask Zach those questions at the end of the program. So feel free to do that throughout.
For sure, yeah. And the content will run about 30 to 35 minutes. I only had 2 cups of coffees today, not 3, so maybe a little towards the 35-minute end, but then we'll leave that next 20 minutes open for Q&A. So beyond my poor jokes, the way I typically like to start the presentation is addressing what normally people say is the elephant in the room, which is what is some young 30-year-old dude doing lecturing on the topic of Social Security. So it actually was driven through a personal event that I went through. And it wasn't my personal event because I didn't claim Social Security at a young age. It was my aunt and uncle. So 2 years ago, my aunt and uncle filed for their benefit. They did file for their benefit before they turned their full retirement age. And they ultimately was subjected to what we will eventually cover very early in today's presentation called the earnings limit. And because they were subjected to that, they had their checks withheld from them. I'm the finance person of the family. My 2 older brothers, one of them spends about 8 hours a day under the hood of a car, and the other spends the other 8 hours a day underground laying cable for Comcast. So my aunt and uncle is not going to go to them. They went to me, of course, and I could do nothing but give them a shoulder shrug back. So knowing that I'm going to be in this industry and fast forwarding 2 years into actually this year, that my own parents are going to be filing for their Social Security benefit, I said 2 years ago, why don't I just take upon myself to learn the topic? I start today's presentation telling that because I know a lot of people on today's call are going to find themselves maybe 50 or 55 and older. But if you find yourselves younger than that, you never know who you're going to end up helping with this information. So I start with that story because I want this to apply to as many people as possible. But typically, the way individuals get started with their Social Security benefit is they usually get their statement, right? Or perhaps they logged online to their account for the first time. Typically, the time in which you'll get your first statement in the mail is usually within 10 years of your first eligibility age of claiming the benefit. So typically between the ages of 50 and 52, you're going to get your first statement. But I can tell you that if you paid at all into the Social Security Trust Fund, you have an account that exists for you on their website on ssa.gov. And just so you're aware, last summer, they did change the login methods. So there's now 2 separate logins that you can go through on their website. Just know both logins are going to get to the information that you need. But if you do need to know, one is specific just to Social Security, the other is all government entities, which of course includes your Social Security benefit. But what typically people do, because I sure did it, is when they get to their account online or they get that statement in the mail, they're immediately going to try to audit Social Security and the numbers and the math that they're doing for you. So you're going to whip out that calculator. First, you're going to attractively seek your eyes to that benefit you're going to get at full retirement age. You're going to go through the ifs and thens. You're going to do all the additives and the average calculations over the earning years that you paid in. But what we feel, which I always say, have fun, try to figure out and analyze and know what your statement means for you. But what we feel is sometimes the most commonly skipped over step, which don't worry, we cropped it out in the top right-hand corner of your screen today. And that is your benefits are not intended to be your only source of income in retirement. So for everyone on the call, it's always going to be looking a little different, right? Some of you may have IRAs, maybe several IRAs, Roths and traditionals. Maybe you have past 401ks or past pensions from previous employers. Maybe you have major assets that you plan on selling, right? To sell that, to have that fund in retirement. Maybe you have rental property, right? Passive income. all of these things are going to source into that post-retirement income picture. And we always stress to meet with your advisor, especially the team that brought us all together here, the Mahoney Group, to know what those outside assets are going to play that key role into when you're going to claim your Social Security benefit. Okay. But of course, today, we are just teed up to talk Social Security, or else we'd be here all day talking about all those other vehicles as well. But here's today's agenda. So, of course, we're going to be talking about your own benefit, right? How it's calculated, how you become eligible for that. And we're going to try to translate that conversation in uniform across all the other benefits. So, we're going to try to treat your own benefit, spousal, survivor, and et cetera, based off of how you become eligible and then how that calculation works for the benefit amount, which includes those options for married couples and divorcees. And then, of course, we're ending with everyone's favorite topic, which is the role of taxes and the way those affect your Social Security benefits. Now, again, as we work our way through, I do want to mention I labeled 5 key gold slides that I definitely will make known when we get to those, because I feel like there's a lot of information to be digested in today's 35-minute run. But if we can at least note down the important takeaways from those 5 key gold slides, I think it'll put our best foot forward when we go to plan. So first off, your own benefit, right? How do we become eligible for your own benefit, and then how it's calculated? First off, we have our first key gold slide, of course, right? Because why not? And it's know what your full retirement age is. Okay. There are so many calculations that are based on or off what your full retirement age amount is, that knowing what your age is first is the first part of planning. And as you see, based on your date of birth and the accruing ages of 66 to 67, usually the question that I prompt when I'm in an open setting, right, is why don't I get a raise of hands of anyone that can guess the last time full retirement age was pushed from 66 to 67? Typically, we get a couple hands, but not a lot of people can guess when. It was during the Reagan administration. Okay, so almost 35 to 40 years ago was the last time that the full retirement age was pushed back. I mention that because insolvency of the trust fund is a very real topic today, but it was also very real prior to the changes made in the early 80s. Okay. So there are multiple ways that they can push the insolvency issue back, and this is one of those. And if you're doing the math like I did when I saw this breakdown, is there are actually currently still people turning full retirement age in that expanded 66 to 67 years. However, in 2 years, in 2027, everyone's full retirement age will finally be 67 permanently. Okay. And then, of course, if there are any adjustments to the insolvency issue to push it back like they did early on, just know, just like they did back then, they're going to grandfather in several years. And as you can see, 40 years from that change, we are still having grandfathered in age FRA ages for some people being before 67. So I like to start with that point, because a lot of people's main concerns when they jump on this call is, will Social Security be there for me when I go to take it? And I can tell you that this is one change that has taken 40 years to make an impact.
Yeah, that's so interesting, Zach. And I find when you think about what the objective of Social Security was, right, it wasn't necessarily to provide retirement income. You know, when Social Security first started decades ago, the idea of spending 20 to 30 years in retirement was like nonsensical. You couldn't even
Correct.
imagine that, right? Social Security was really intended to be insurance for longevity if you live past your average life expectancy. So
Right.
Social Security has morphed into something that has become dependent on the American retiree as a portion of their income, and the government's trying to work its way through that. And you know, by the
Yeah.
end of the conversation today, I know you're going to hit on a lot of that.
Yeah, for sure. So this is just one of those prime examples that I always like to point out as probably one of the more understandable or justifiable reasons to push full retirement age back to help fix insolvency. Because to your point, life expectancy, modern medicine, people are living a lot longer than they did in the early 80s, and that was the last time they made a change like this. So next, our next slide is knowing when your own benefit, when you become eligible for that benefit, and then when it's calculated. So starting off right at the top there, to qualify for your own benefit, you do need 40 quarters paying into the program. And yeah, that's a fancy way of saying 10 years of earned income paying into Social Security. Okay. Now, to figure out what your benefit will be at full retirement age, they then base those earning years off the 35 highest average. So if you're doing that math again, right, there's a lot of math when it comes to Social Security calculations, but that 10 years obviously doesn't equate 35 years. So if you become eligible and then maybe take years off to caregive for a newborn child, then just know that if you don't have a total of 35 years paying in, there will be zeros that go into your average calculation. Okay. Then, as we see on our screen, we're going to take a look at those impacts of claiming our benefit before or after we turn that full retirement age. Okay. There's an important thing to note that if you take any benefit before you turn that full retirement age, just know that your benefits will be permanently reduced going forward. Okay. And we're going to touch on that briefly on another slide to prove that point. But typically, when I go over the pluses and minuses of your benefit based on the age you claim, the normal feedback or the question that I get is, hey, Zach, why don't I just take my benefit as early as possible at 62? I have a great advisor team. They're going to invest all my assets. Can't I get more from a total return perspective if I do that than just letting it grow naturally? And for that scenario, and sorry, Kristen, I'm not looking to see if you're palming your forehead or putting your head on your
No,
table by me just mentioning
we
that.
are aligned, Zach. We are aligned.
Yeah. So for any of those scenarios, I will always say it is case by case. Always consult your financial advisor, whether for your situation that is best. If we're going to try to extrapolate any research or data from those events, the Journal of Financial Planning just 2 years ago in 2023 asked that very same question. They went back 100 years of market returns and they say best to take it right away and invest or let it grow naturally with the automatic inflation adjustment, which I didn't mention because as you see, you get that 8% growth up until 70, and that is in addition to that inflation adjustment, which Social Security calls the COLA adjustment, the cost of living adjustment. Okay. So they asked that question, right? Better to let it grow naturally with the inflation adjustment or invest right away. And in around 80% of all cases, they did find it was best to let Social Security grow naturally with inflation adjustment. Of course, it's case by case, and 80% is not all cases, so it is possible. But I will say that the data that it came back that made them come down with that decision, a couple hard data facts as well as a social behavioral take. One of them was it is actually pretty difficult to beat the 8% year over year growth with inflation adjustment. And they came back with saying, your stock, bond, or mutual fund or your investment vehicle, that may return more than 8% in a given year, but your profits might reflect differently since you're perhaps dollar cost averaging month over month as you get the checks instead of, say, just a lump sum at the first of the calendar year. Second point to that is they found that individuals, when they're taking Social Security, understand the age demographic, right? To beat that growth, that rate of return, you typically would have to invest a lot more riskier than what your age-based or just your overall preference of risk tolerance would suggest for yourself. And then lastly, which is again more of that social behavioral take, they found individuals to find it a lot easier to budget their post-retirement income on a fixed dollar amount, right? Social Security fixed, you're getting the same check every month as long as you're not doing earnings limit stuff, but we'll get to that. It's a fixed amount versus an investment with a hope of a return, right?
Yeah.
So a lot of people don't include that stress factor when it comes to investing your Social Security assets with a plan of that instead of letting it grow naturally with a fixed amount getting in post-retirement income.
Yeah, the key
So
is you can't spend it, right?
yeah,
Like you need to invest it if you're taking it early. And a lot of
exactly.
people are tempted to spend it. It's a similar conversation to whether or not you take an annuity through a pension option or a lump sum on the pension.
Right.
And another way that I think about this, and maybe I'm in the minority with advisors because I think we are incentivized as an industry to encourage people to take money so that we can increase our assets under management. But for you to replicate the income stream that Social Security is going to pay you, you would need I mean, I would say millions of dollars in a bond portfolio to kick off that same income. And I really like the aspect of having a portion of your living expenses on a fixed dollar amount. So that,
Correct.
and I'll tell you, I've spoken to investors who live, paycheck to paycheck, and those where Social Security is a bonus. But there is just something meant like psychological about getting that fixed check. They like to get that check,
For sure.
even if for people who are gonna outlive their who are not gonna outlive their wealth. So for sure.
Yeah. Yeah. And if you're an OCD budgeter like myself, imagine how you're doing it right now while you're working. Imagine if you don't have that stream of employment income, how OCD that budgeting is going to get when you have all the time in the world to figure out, what's going to last, what to take, when to take, and all that. So a lot of people don't include that stress factor. So I appreciate those points, Kristen. Um, and all of these types of decisions that we go over when to take, obviously, to that point that I made, it's case by case, right? So when we look at planning situations like this, we don't look at it as just straight up an age-based decision, right? It's always going to be situational based.
Mhm.
So when we go through the planning steps, we always ask first, are you working? How long do you plan on working? Are you married, widowed, divorced? And what's your tax situation? Right. So those are the things that we're going to try to dive into more today to help you give more light of where you might find yourself if you ask those questions. So going into why we asked that question first, our second key goal slide of the presentation, which is that earnings test. And we can all thank my aunt and uncle's mistakes for why I'm here today, because this is the slide that they made mistakes on, right? So Social Security has something called that earnings limit or the earnings test, okay? And it says that there's a limit to how much you can earn while taking your benefit, okay? Now, big three bullet points there when it comes to the earnings limit is one, it's only going to look at the individual taking their benefit, right? So regardless of your tax filing status, individual or joint, if it's you and your spouse and you're the only one taking your benefit, only looking at your wages, okay? Second, it's only going to look at those gross wages. So unearned income such as like pension, IRA, rental, property income, stuff like that is not going to be included. So 99% of the time, it's what's reported on a W-2 or a 1099 in that regard, right? And then lastly, sometimes most importantly, it's only going to consider, or this effect, excuse me, is only going to impact you if you turn your benefit on before full retirement age. Once you turn full retirement age, go ahead and rip up this page like your dog did your sixth grade homework. Social Security does not care how much money you make after the fact that you turn full retirement age. Okay. And then as you see on the top of your screen there, it's affecting everything. So it doesn't matter if we're talking your own benefit, a spousal off your spouse, survivor off of a deceased spouse, disability, divorce benefits, earnings limit will always affect you if you're collecting before full retirement age. Okay. So this is exactly why we always ask this question first, because we feel like if you're under full retirement age, turning your benefit on, still working, probably not beneficial for you to just see checks withheld from you. Okay. And then as we move on, so we figured out your own benefit, right? How you become eligible for that, how it's then calculated, and then those common mistakes that trip you up on your own benefit. So then we go into options for married couples, which includes first the spousal benefit. So even if you've never worked, you may receive up to 50% of your spouse's benefit at full retirement age. Okay. Now, again, treating these benefits, trying to uniform, right, to get that message across, we'll start with eligibility. So how do I know I'm eligible for a spousal benefit off my spouse? Three major requirements. I'm sure a lot of us in the room can probably guess one of them, which is you have to be married, right? And then that length of marriage rule, when you go to claim the spousal benefit, means that you have to be married for at least one full year. Okay. The second requirement is that your spouse must also be receiving their benefit to get one off of them. Okay. And then third and lastly, you have to be age 62 or older to get that benefit, just like your own benefit. Now, some of the things that I want to work out where how it's calculated is once we know that you're eligible, the calculation of what your spousal benefit off your spouse is based off of is always what their full retirement age amount is. Okay, so remember on that first key goal slide, I say know what your full retirement age is, and then that benefit you get at that age is. Now's the opportunity where if you happen to be sitting next to or watching with your significant other, give them a little knee or elbow to the side because your spousal benefit off of them is again based off their full retirement age benefit. Okay. They then take that amount and then they're going to multiply it by the percentage that corresponds with your age when you take that benefit. And you can see on your screen now those percentages drawn out with the ages underneath. Okay. A couple things to note there is that if both you and your spouse worked, okay, you can no longer, because Social Security got rid of this about 8 years ago, you can no longer start with either your benefit or the spousal off your spouse and then switch. Okay. What Social Security is going to do is when you file for your benefit, you technically are filing for both yours or the spousal off your spouse. They will give you just whichever is higher. Okay. And then additionally, divorcee benefits, they're calculated the same way, but there are some differences in the eligibility portions of that, which we'll cover on the divorcee slide. Okay. So now that we talked the eligibility for a spousal benefit and how it's calculated, let's go through a quick case study to give it some real life context. So here we have a little ditty about Jack and Diane, right? Two American kids growing up in the heartland. I really hope everyone's familiar with that popular John Mellencamp song, or else this slide goes over everyone's head.
I'm going to have it in my head all day. Thank you.
Right? It's a summer song, right? It should be. But the little twist that we're throwing on this is Diane now is the star athlete, so she's the higher earner, and then Jack is going to be that butillion. I'll save you the Google search. A butillion is a male's version of a debutante. Okay. Now, what we want to know is, since Diane's the higher earner, what is Jack's maximum or minimum spousal benefit off of Diane based off of their different claiming ages? Okay. So assuming both full retirement age is 67, what we see on the left is Diane's own benefit for her based on the ages she claims her own benefit. In the middle, we're going to see Jack's minimum spousal off of Diane if he claimed at 62. And then on the right, we're going to see Jack's maximum spousal off Diane if he claims at 67. And as we see for Jack's scenarios, right, it doesn't matter when Diane claims her benefit. Jack's spousal off of Diane will always be based off the dollar amount she's getting at full retirement age, to 10,000 in the middle. And then his amount will always reflect the age he claims that spousal off Diane. Okay. Now, remember those eligibility requirements? In this case, Diane has to be taking her benefit for Jack to get one off of her. So let's throw another twist to the story and say, well, what if Jack is eligible for his own? He decides to take his own first, and then Diane files years later, right? Jack's only option is to start with his own. So we can see how Social Security will, quote unquote, top off Jack's amount once his higher earner spouse, Diane, claims her benefit. Okay. So what happens is exactly on your screen. What they're going to do is they're going to do the math of Jack's maximum spousal, right? So that full 50% of Diane's full retirement age amount. Then they're going to subtract whatever Jack's full retirement age amount will be, his amount at full retirement age is. And then whatever's left over, Jack gets added on to what he's already getting, okay, once Diane applies. Now, I know going through that scenario, I'm sure I just lost half the room. So yeah, we have another case study that hopefully explains that and gives it a little better light. So here we have our ABC hypothetical, our Alex, Blake, and Chris, right? They're all married. They're all 62. They're all taking Social Security. And what they want to know is, what am I going to get now? And then what am I going to get once my spouse applies? Okay. So what I'm going to do is I'm going to populate all three scenarios at once. I know there's a lot on your screen. I only want you to pay attention to the gray bars up top and then the green and the blue. Okay. The blue is what they get starting off. The green is what they get once their spouse applies. And then the gray up top is the math we just showed on the previous slide. Okay. So starting with Chris on the left, this is a very traditional way we talk spousal benefits. Chris isn't eligible for his own, as you see N/A at the gray bar for his own retirement benefit. So he's only eligible for a spousal. When his spouse applies, Chris is 67, so he gets the full 50%, the $1,200. But in real world, it's not usually that easy to follow. And typically scenarios in the real world is closer to Blake in the middle. So Blake's scenario, as you see the gray bar, his full retirement age benefit being $1,000. He takes early at 62, reduced by 30%. So Blake starts with $700 a month. Okay. Then fast forward 5 years later, Blake's higher earner spouse applies. Social Security does the math, 1,200 minus 1,000, $200 left over. Now that gets added on to Blake's already received amount, 700 plus 200. Now Blake is going to get 900 a month. So remember I said in a previous slide that if you take your Social Security before you turn full retirement age, you're going to permanently lock in a reduction to your benefit. This is the proof of the pudding. Because Blake took his own benefit early, he's going to lock in the reduction. And just because his higher earner spouse applies when Blake is 67, full retirement age, doesn't mean he gets immediately 50% of the spousal benefit. Because he took his early, he's just going to get the top off. Full 50% would have been $1,200, but Blake's going to get the $900 a month for claiming earlier. Okay. And then we look on the far right with Alex, which starts the exact same way as Blake. But unfortunately for Alex, his spouse is not as wealthy as Blake's spouse. So because the math tells us 1,000 minus 1,000 for Alex is 0, Alex just doesn't get a top off when his higher earner spouse applies for their benefit. So just take a quick look at all three scenarios, right? If you're looking at Blake and already trying to whip out that calculator, I don't want you to focus on that granular math just yet. Okay. What I want to stress by going over these examples is that Social Security should never be treated as strictly a me benefit, because you can see it has we impacts. So it should be treated as a we benefit between you and your spouse. So anytime you're meeting with your advisor team here, especially with the Mahoney Group, it's important to, at minimum, have you and your statement there physically present, and hopefully your spouse's statement as well. And what we hope is your spouse physically present as well, because it's important for them to also understand how both of your benefits work out for both of you. Okay, we of course want to hopefully help you put the best planning steps forward, and having both you and your spouse and your both statements there will allow your advisor to be able to look at both scenarios and make that best advice for both of you as a we benefit. Okay.
Zach, I think our audience is understanding the we benefit, because I did just get a question about whether or not this video is going to be available to share. So maybe you want to share it with your spouse. And yes, I just want
Absolutely.
to remind everyone that we are recording this session. It's going to take a week or so for it to get through both of our compliance teams, but once it is, we'll be sure to share.
For sure. So yeah, we went over that spousal and all those kind of hiccups and common questions, eligibility calculation of that. Now what happens if your spouse unfortunately passes away, right? In addition to those spousal benefits, if you've ever been married, Social Security does offer also survivor benefits, right? So addressing this the same way we talk spousal, starting with eligibility, how do I know I'm eligible for a survivor benefit off of a spouse? Well, two major requirements. And again, I'm sure we can guess one of them, which is you had to have been married. Now, that length of marriage rule is you have to have been married for at least 9 months when your spouse passes away to become eligible for a survivor benefit off of them. So no, you can't just marry somebody with a death sentence. That's a bit of a morbid way to plan Social Security, but you do have to be married for 9 months when you go to become eligible for that survivor benefit before they pass. Okay. The second requirement is you have had to, you have to be at least 60 or older, so different from those spousal and your own benefit. Just like your own benefit and the spousal, right? There are some exceptions to that age requirement of 60 or older. We can always address those if any in questions, but they're usually dealing with disability or minor children in care at that age. Okay. Now, once we worked you're eligible for that benefit, how is it then calculated? Kind of similar structure that the spousal calculation worked, right? Except for the amount that we're basing the calculation off of is whatever the deceased was receiving at the time of death, right? So if they continue to grow their benefit at 70 and they took it at then, that's the benefit amount that we're basing the survivor calculation off of. And if they happen not to claim their Social Security benefit and passed away before they turn that full retirement age, up until they turn that full retirement age, if they passed away before that, their amount immediately jumps up to whatever they were going to be receiving at full retirement age. Okay. And then similar to how we treated the spousal, they take that dollar amount and then they're going to multiply it to the percentage that corresponds with your age when you take that benefit. However, there are 3 major differences that I want to point out here when it comes to survivor versus spousal. First one we already mentioned, it's the minimum age requirement, 60 versus 62. They give you those couple extra years to claim that benefit because they understand you just lost your spouse and you may need those couple of years extra to get more money off them. Okay. The second major difference is, it might be clear to some, but I like to point it out, it's the percentages. If you notice, the max spousal percent was 50, the max survivor is 100. Okay. And then the last, but the most important difference is, remember when I said you can't start with your own benefit or the spousal and then switch? They're just going to give you one of the two that's highest. With survivor, you can. So in the process where you have a higher and lower earner spouse, and the lower earner spouse is the one that passes away, the higher earner spouse can technically turn on the survivor benefit of that lower earner, start making some income from them on that survivor benefit while they grow and maximize their own, and then make that switch when it's best for themselves. Okay. So those major differences, I find it crucial to point out. But just to give it a little bit more light of the jump up of the survivor benefit and what that entails, is a quick case study here of the higher and lower earner dollar amounts that you see on your screen, and then the ages that they claim their benefits at the bottom. So they both start at 65. Higher earner gets 3125, lower earner gets that 1042. Fast forward 10 years, the higher earner passes away, the lower earner is 75, or at least full retirement age or older. So they're eligible to go from their benefit to 100% of what that deceased was receiving at the time of death. Okay. And then the last slide that I want to show when it comes to survivor benefits, and this is actually our third key gold slide, because I feel like this really stresses and emphasizes the impact of the higher earner's decision to claim their own benefit. Okay. So for this slide, just for the sake of the argument, let's pretend both blue and green are a married couple. And again, to prove our point, let's say blue took as soon as they could at 62 on the far left, getting that 23K a year. And then green took on the far right, maximizing their own benefit, getting 59K a year. If green were to pass away, blue can go from 23,000, as long as they're full retirement age or older, to 59,000. Okay. Now, if we threw a needle in that and said, well, what if green also took as soon as they could at 62? Now that's going to bear in mind the question, does an extra 21 grand a year make a difference to that surviving spouse? Where did I get 21 grand from? Well, the difference of 38,000 a year for green on the far left versus 59,000 a year green on the far right is that 21 grand. So we always say that allowing that decision to grow and maximize the higher earner benefit, we understand that might mean that you don't get all your benefits from Social Security across your lifetime, but it does mean that you're doing the most you can to protect your spouse financially if you were to pass. And sometimes that alone is worth the decision to maximize and grow your benefit. Okay. So I like to point that out because, again, we stress the we conversation and knowing the important factor of the higher earner's decision and that impact that it has over both you and your future income, but also your spouse and your perhaps surviving spouse as well. So then we go into if you happen to ditch your spouse, right? Again, probably a poor way to phrase that, but you talk enough morbid scenarios when you talk Social Security enough. So going over those eligibility requirements for divorcees, how do I know I'm eligible for, say, a spousal or a survivor benefit off of that former spouse or that ex? Two major rules. Okay, first one is you had to have been married at some point, and the length of marriage rule is 10 consecutive years. Okay, then what they do is the second rule is called the 2-year rule. So that means that if your divorce was within the last 2 years, right, to take a spousal off your ex, you do actually need your ex to be taking their benefit to get one off of them. So same as the traditional spousal rules. But if the divorce has been beyond 2 years, you don't need to wait for your spouse to take it. You can take a spousal off of them, even though they haven't filed for their own. Okay. Then everything is the same as spousal and survivor, right? Calculation is the exact same. Have to be 62 or older for spousal, 60 or older for survivor. All of those are the same. Okay. But what I want to get across to any divorce ease on the calls, or dare I say future divorcees, again, morbid scenarios, is the remarry rules. So traditionally, if you remarry, you're going to forfeit the benefits off of your ex, but two major exceptions there. One is if you remarry after 60, you're going to retain the survivor benefit off of that ex. So you were married 10 consecutive years, you got divorced, you fell in new love at the age of 58. If your new spouse, especially if your new spouse makes less money than your first spouse, you may want to wait to drop the knee to propose until you hit age 60 so you can retain that survivor benefit off of your richer ex. Okay. And then the second exception is if then that second marriage ends, and that can be through divorce, annulment, or death, you could become re-entitled to the benefits off the first marriage. Just like prior examples that I'd explained, I probably lost half the room, or I gained half the room with them trying to go through all the ways they can try to position their marriages of the past to maximize their benefit. But to hopefully explain that a little bit better, I like to talk about how Jane Fonda has set herself up better than anyone I know that exists on this planet for her Social Security benefit. So what Jane did is she was married to both Tom Hayden and Ted Turner, or as you see Theo on your screen. Both marriages lasted at least 10 consecutive years. Both marriages ended in divorce. So the options for Jane when she takes Social Security is the highest of her own benefit, which I can almost tell you is probably not small, but the highest of her own benefit, the survivor benefit off Tom, since he has passed, or the spousal benefit off of Ted Turner, since he is still alive. Then, if Ted Turner kicks the bucket, she could switch to the survivor benefit off him if it's higher than any of the current benefit that she's collecting. Okay. So I hope that explains a little bit of the divorcee benefits and how that works, becoming re-entitled and etc. So the last and our ending topic, which is everyone's favorite to discuss, is taxes and the role taxes play within your benefit. I always like to disclose when I open this section is I'm no CPA. Of course, I know what it comes to when taxes affect your Social Security benefit, but we always stress that understanding your total tax liability is best stressed through both your advisor team here at the Mahoney Group, as well as a qualified tax professional. But with that, regardless of your age, once you start taking your benefits may be taxable if your income exceeds $25,000 filing single or $32,000 married filing jointly. Now, the good thing is, and I know it's very rare that you can say there's any good things when you talk taxes, is that currently they're not 100% taxable coming out of your benefit, right? Now, I know the current administration is trying to position ways to try to take the tax out of your benefit, right? Just so you know, the changes to Social Security has to be done on an amendment to the Major Congressional Act of Social Security. So there's no federal administration initiative, or it can't be done through a budgeting act through Congress. It has to be done as amendment on the official Social Security Act. So that's ultimately how changes are going to be made, right, on how this is treated. But there's ways in which the current administration is trying to, tiptoe around that and still try to give you a little money back for people that are affected by this the most. So right now, your benefits are not 100% taxable. I throw an asterisk on that because that's always subject to change. But the administration currently does provide at least that 15% cushion to what is owed to Uncle Sam. Because as you see on your screen, even if you're at the highest income threshold, only 85% of your benefits are taxable. Okay. But I do get it, right? It's frustrating. You spent your whole life paying into the trust fund, and now, of course, it's being taxed on the way out. But the way I like to approach taxes when it comes to Social Security, and my advice from a non-qualified tax professional on how you should approach almost every taxable equation, is use the G.I. Joe approach. What is the G.I. Joe approach? It's knowledge is half the battle. And if you can at least know the taxable equation, what goes into it, then it'll allow you to play a little defense, right? So taking a look at what that is, the government, to determine how much of your Social Security benefits could be added to your income and thus become taxable, the government uses what's called combined income. And that's what's on your screen now. It's adjusted gross income plus your tax exempt income plus only half of your Social Security benefits. Okay. Now, there are some investment vehicles that are not included in this equation. And I feel and stress that it's important to know what those vehicles are. And of course, approach your advisor and their team about those, because if you can maybe rely on some of those other vehicles while letting Social Security grow, and then Social Security becomes a higher portion of your post-retirement income picture, that can also allow you to play defense. Now, how does that play out? This is a little example. It's our fourth key gold slide of the presentation because I really feel like it emphasizes that by letting Social Security grow, how that can factor into playing defense on taxes. Okay. Now, this case study looks at a married couple after tax income goal of 75K, and they're looking at claiming at 62 versus 70 and what it means for their Social Security benefit in their outside accounts. Okay. And as we see, if they claim at 70 versus 62 on the far right, most of that 75K is made up of their annual Social Security benefit. Okay. And yes, this is a married couple, not an individual, right? So 75K of the 75K from Social Security, which then means less from their tax deferred accounts are relied upon to make up the rest, which means their combined income equation goes down by a dramatic amount, which means their taxable Social Security liability goes down, right? Ultimately, as we work our way down row by row, you'll see federal income taxes reduced by about 2,600. My full disclosure on this slide is this is a perfect hypothetical. What it's not meant to do is it's not meant to tell you that if it's even remotely possible that by letting Social Security grow alone is going to help reduce your federal tax liability to zero. What it's meant to do is just by letting it grow, it can help be a factor in that defense you play in taxes, right? Again, incorporate your financial advisor team, the Mahoney Group, to talk about those tax deferred accounts, and then a qualified tax professional to talk about the holistic approach in your post-retirement income. Okay. Now, on that previous slide, I mentioned some of the vehicles not included in the combined income. Some of those examples are on your screen. I'm not going to go box by box, but quickly highlighting the Roth. Anybody that has the ability through their employer to increase contributions to things like Roth 401ks or Roth 403bs, even those that have the ability today to open up that Roth IRA, having a Roth vehicle can help you play the biggest defense in controlling your taxes in retirement. HSA, my brief note on that, because it has to do with Social Security, is once you take Social Security at age 65 or older, you are automatically enrolled in Medicare Part A. And because you're in Medicare Part A, you can no longer contribute to an individual HSA. And I'm not going to tell you why I emphasized individual, but just know there are things called family HSAs, and there could be a loophole there. Who knows? But you can be penalized for contributing to an individual HSA if you are taking Social Security at 65 or older. Okay. Now, I briefly mentioned those Medicare factors on previous slide, and I know Kristen mentioned that we're going to end with a brief Medicare to kind of segue, build out to the next month's presentation. Why do we talk Medicare when we talk Social Security? Is because once you're actually eligible for Medicare, your premiums are going to be taken from your Social Security check before they hit your bank account. So a lot of people go to their advisor and say, why did my Social Security check get reduced? When in reality, it didn't. It's your premium was increased, right? So we like to make you aware of what normally increases your premiums so that you know if you see that reduction on your check, you know why, right? So this is the breakdown for 2025. The two things I just want to highlight quickly is the bold in the bottom right. Premiums are based off of your monthly adjusted gross income from 2 years ago. So for those of you that perhaps plan on selling a major asset, right, to fund that fund in retirement, just know, of course, the tax consequence in the current year you sell that asset, but then also your premiums 2 years down the road, right? There is a form that you can file to Social Security to update them on your current year income, but there are reasons to file that form. And I believe there are 7 reasons that you can file that form. Retiring is one, selling a major asset is not. So that's why we point out that particular scenario. The second thing I like to highlight on this slide is what we call the widow trap. And that's better explained through a hypothetical. So say me and my wife filed jointly at 210 grand a year, right? 210 jointly, as you see on your screen, is in the top row. I make 150, my wife makes 60. Say my wife unfortunately passes away. I file individual at my same income, 150 the next year. And as you can see, if we follow the individual column, 150 is now in the third row, which essentially doubled my personal premium. Okay. So if I'm taking my check, I'll see an additional amount taken from my Social Security check once my spouse passes away. When people traditionally think when my spouse passes away, I see an increase in Social Security. So just the things we like to point out as it usually bubbles up from a Social Security scenario. So my last slide and our fifth and final key goal slide of today. And I really appreciate everyone sticking with us. Is it reality that you're going to digest everything that we showed today? No. But of course, we want you to take home some of the most important factors as you prepare for your planning. So those are what you're going to find on your screen now, and why we ask those questions first when we go through planning steps of, are you working? How long do you plan on working? Because we feel like if you're under full retirement age, not really justifiable to see you turn your benefit on just to see checks withheld from you. Okay. Your withdrawal rate. Sit down with your advisor team at the Mahoney Group, understand how your outside assets and those other vehicles are going to come into play for your post-retirement income, right? If that means letting Social Security grow, all the better. Third, life expectancy. We really only ask this question for those that are single, and I'll explain in a second. But if you're single, know your family health, right? Know your personal health, of course. If you have great family health, great personal, best to maybe let it grow as long as your other outside assets allow that decision. If you have poor health, poor family health, best to consider maybe to take it a little earlier. Why don't we care about life expectancy to married couples is because data tells us that there's a 50% chance one of the two spouses are going to live until age 90. So our general rule of thumb for married couples is lower earner, take whenever you want. Higher earner, try your best to maximize and grow that benefit. That's how you're going to maximize the most from both of you over Social Security, over both of your lives. And of course, maximizing the survivor benefit if you were the one to pass and your spouse was the one to continue you. So, of course, always case by case when it comes to that. But we always stress those important three factors when we go through the steps of planning. So with that, we can end. Kristen, we can go through the Q&A if any. I always like to end to tell people that, to your point, as you started, we have guides that have pretty much every image that you saw on today's screen with the additional context I provided that, of course, every attendee today can get through Kristen. And we don't stop being a resource when we end this call. So in case you're thinking,
Well said.
my scenario is very personal to me and I feel a little timid speaking up in a group setting about that, please still get your questions bubbled up to Kristen and her team. She has my hotline. She has my inbox. She can flood my inbox with your questions. If it's easy for us to just hit that reply and get your answer, we will. But if we find the scenario being a little bit more complicated and requires some probing and back and forth, we can perhaps coordinate some one-on-one time between you, your advisor, and us to get those answers.
Well, Zach, I think thank you so much. This is
Yeah,
just a wealth of knowledge. The good news is that this group is clearly not shy. I have been sitting on a few questions that I'd like to throw your way.
I love that. Yeah.
The first is, what about if your spouse is approved for Social Security disability prior to full retirement age? How does that impact the we conversation?
So great question. I appreciate you asking that. It doesn't necessarily impact the we detrimentally, if I can, and I'll extrapolate a little bit more. So if your spouse got accepted through disability, it's only affecting her benefit. Nothing is going to change based off of your benefit off of her. So if you're thinking like, hey, she's 58 or 59, she got a disability benefit from Social Security. Now she's not really seeing a reduction. She's almost getting what she would have gotten at full retirement age at 58 on disability. Your benefit off of her is still going to go through all the same steps. You're still going to base your percentage off of the age that you take the spousal off of her. You're still going to require be 62 or older to take it off of her. And the math that you're calculating off of her is still her full retirement age amount. The only difference is she's able to get more earlier because she's disabled. And then, of course, personally to her, there's other things that she gets as a benefit too, with more of a fast tracking to Medicare earlier and all that. But as far as as far as the impact of yours off of her, zero.
Okay, that's helpful.
Yeah.
How about if my spouse and I both claim at full retirement age and her amount is higher than mine, will I get the difference added to my monthly payment to make them equal?
Yeah. So they won't be equal. What Social Security will do is if you're both filing for your own benefits at full retirement age, they're going to look at, since you're eligible for 100% of yours or 50% of theirs at that age, that's what they're going to look at. And they're going to give you whichever one's higher. So typically when we look at that step up rule, it's those that have a bigger separation of benefit amounts. So it's those that have like one higher earner is like a 5K a month and the other one's like 1K a month, where we see like that dramatic step up, right? When the higher earner spouse then applies and the top off calculation is done. But for those that have closer aligned benefit amounts, even if you're maybe like 1,000 or a few hundred off, 50% of theirs is still less than what your like max reduction would be, for example. So you're still just going to get your own benefit.
Yeah, so the
Um,
whole idea of a spousal benefit is applicable if there's a wide disparity in the income of both spouses, right? I
right.
mean, in other instances, you're going to take your own benefit.
Yeah. Yeah. They're just going to give you the highest of the two. And if you think about it, the max reduction of your own is that 71.5%, but the max you could get off your spouse is 50% of theirs. So even if you take at 62 and your benefits are kind of aligned, you're probably still going to get just 71 and a half of yours instead of 50 of theirs.
Got it. Okay.
So
And if you can hang in there, we just got a couple more.
yeah, yeah.
Does the potential additional survivor benefit, Social Security benefit from a surviving spouse automatically switch, or do you have to do something extra?
Great question. You have to do something extra. I appreciate you asking because I didn't make the point on the slide. Survivor benefits have to be filed in person. Okay. So that's
Oh,
a major difference than your own benefit and a spousal
yeah.
that can usually be done through your online account filing or over
Mhm.
the phone. Survivor has to be done in person. So yes, there is an actionable step when your spouse passes, but it's not immediate. They do let you post date it 6 months because they understand like people are grieving, right? You just lost your spouse. So don't worry about it being immediate. You have things to worry about, estate planning, grieving, and all that. They will allow you 6 months post date your spouse's death to predate that survivor claim. And what'll essentially happen is you'll get a lump sum payment for that in between period and then future checks. But yes, great question. Survivor benefits have to be filed in person. And just know that the current average wait times for in-person meetings with Social Security can be anywhere between a month to 3 months out, depending on where you live in the country.
Wow. I
So
didn't realize that.
yeah, with that, I would say that if your spouse passes, my biggest thing, and because, and I'll say this is because we talk to advisors and coach advisors, you should reach out to your advisor and just say, hey, my spouse passed. I know there's some, things that we have to handle financially, Social Security,
Yeah.
our beneficiary
Yeah.
info, estate
Hmm.
planning, make them aware, and they should be able to timely reach out to you after a grieving period to say, hey, let us know if you're ready. We'll let you know what documents you should bring in, and we'll make sure you're well prepared to get everything, and make sure you don't lose anything at the same time. So that's my stress, is just let your advisor know and let them be proactive doing their job to let you know of when, whenever you're ready, done grieving to handle that process.
Yeah. And then lastly, if my spouse died before retirement age and is the higher earner, am I getting mine and his combined?
Not combined, but if your spouse passed, they were the higher earner, but they never claimed their benefit, the survivor benefit off of them. And if you were still married when they passed, just know you have to be married for at least 9 months. But as long as you're eligible, all that, your first eligibility date to take their survivor benefit is age 60. Those reductions apply. So if I went back quickly to that survivor page just to show your breakdown of when you take that benefit, um, your starting age is 60 to take it off of them. The number you're going to be basing the calculation on is whatever their full retirement age benefit would have been, because they passed before that age and they never took their benefit. Social Security immediately jumps their benefit that their survivor benefit is based on that full retirement age of theirs. Okay. Then, if you see across your screen, based on when you take that survivor benefit, that percentage you see that corresponds with your age is how much of that amount you're going to get. But the major difference I want to make clear to you is that you can actually start with your own. So my always advice is that if the higher earner passed away before taking theirs, right? I, unless you need it between 60 and 62, just start with your reduced benefit at 62 so you can start getting something, as long as you're not working and right, not subjecting yourself to the earnings limit and not
Yep.
getting a check anyway. But you can
Mhm.
start with yours at 62, right? Start to get something while you maximize the survivor percent to 100% at your age 67 and then make the switch at that point. So you get more of the survivor benefit off your higher earner spouse. If you need that money between 60 and 62, it's a change of the game, change of the planning. But if you can wait, then my advice to that scenario is always try to take yours first while you grow the percentage off that higher earner benefit.
That's a great point. And lastly, there was a question about the amount of the highest income and the number of years. So it's just to clarify, it's 10 years or 40 quarters to qualify, but then once you qualify, they're taking into account the highest 35 years of income, not 10.
Right.
That's right.
Yeah. So 10 to qualify, 10 to get to the party, right? 35 to base your average off of. Right. And that's why I made that example. There's a lot of people that take a couple years off of work to care give a
Yep.
newborn child, especially, back in the 70s and 80s and 90s, people that were working that are now going to be taking their benefit. It was a lot less often that companies offered things like maternity and leave like that. So it was a lot more common for the demographic today collecting their benefit to take years off. And that's why we mentioned that, just so that you know that if you don't have 35 total, they will equate zeros to that calculation.
Interesting. Here we are at 1 o'clock. I thought I'd be asking you my questions, but I think 60 minutes is enough on Social Security. Just want to recap. Please consider my team and through Zach, an extension of my team, a resource. This is an important topic. It's not really relevant until it's relevant, right? So, I love the context that Zach provided about educating those that loved ones and those that you care about. But if you're 40 or 45 years old, you don't need to be making a decision today about how you're going to claim Social Security, right? Like this is really more a conversation that you want to have and spend some more detailed analysis on as you're thinking as retirement's in sight, maybe 10 years
Yeah.
before retirement, late 50s, early, certainly early 60s, as you think about how does your Social Security income fit into your overall income, and how does that compare to what you're going to need to live off of in retirement, which is clearly a very personal conversation. So thank you for joining us today. Be on the lookout for the materials and the recording. They should be coming out to you in about a week or so. And if you're interested, I would argue perhaps maybe, dare I say, an even more complicated topic, but Medicare, certainly more options, will be coming to you August 21st. So mark your calendar. Thank you so much for your time, Zach. Thank you for your knowledge and for your coordination of this event. I think it went great, and we're looking forward to continued conversations.
My pleasure. Thanks for having us, and thanks everyone out there for joining us.
Awesome. Thank you. Have a great
Take
week.
care. You
Take
too.
care.